What's up, everybody? Michael Silva here. You're watching the Daily Stock Market Brief. Today's date is October 26th, and it has been a crazy day in the markets. In today's video, we're going to be separated into multiple sections. We're going to be talking about the indices, mainly around just in the S&P 500. I'll quickly touch on the NASDAQ, but I also kind of want to re-show you a chart on the semiconductors and also the transportation index. Those two are big indexes, and I want to get into them. Then we're going to hop into just a couple indicators, commodities, yields, and the US dollar. Got a lot to talk about. Let's get into it. All right, welcome back. If it's your first time here, welcome to the show. I do these Monday through Friday. So if you like this type of content, if you want to get technical analysis on the markets every single day and look at key levels, determine where the market might be headed next, please subscribe to this channel and smash that like button. We're going to get into the S&P 500 here, but first I want to kind of talk about, what drove the market down today, and really kind of what the consensus is around the daily COVID spike in cases being really high, and we saw a big pull down in the market because of that data. Now, there's other things that could have triggered this or caused this to happen, but that seems to be the consensus as to what was really driving the market down specifically today. Now, when we look at this chart, this is the weekly time frame for the S&P 500. And really, last video or so, we were talking about this kind of back and forth, two different types of reversal type candles. Not this one. This one is not completed because it's only Monday, so this is one day. And the two last weeks, though, this 1 week here, 2 week there, one had a long upper wick and one had a long lower wick. So they were very conflicting. And we were talking about, okay, if we get a week that closes above, we can go on a run. If we get a week that closes below, we can go down. And Monday started off with a nice gap down, getting back under this level of support and being under the 5 EMA. So the bears, they're still here is the overall message today. The bears have not given up. They're still working this market to potentially push lower. Now, once we get into the other time frames, you're going to see like, okay, yeah, it was a big move to the downside, but it's not like they took over this momentum yet. So we'll get into it. Here is it on the daily time frame, and this is kind of what I mean. So here's a bull flag still within play. So, today we came down and we closed another one of the gaps. And, I remember talking about the gaps when we have 5 or 6 gaps on this ramp up. And we did the same thing in August. We talked like, this is weird. There's just too many gaps. And, a lot of people in the comments, and specifically just a lot of people out there, believe that, gaps don't matter. Well, gaps really do matter. It's just a bunch of air pockets, and what you can typically see happen is more aggressiveness and volatility pick up to fill those gaps. And, here in August when we had this big, huge, massive run up, right? And then in the month of September, we knew that it was overextended move, and we got all those gaps filled. And then we saw the same thing right here going into mid-October, just a big ramp up. Then we started talking about, everything looked overextended, including some of the indicators we were talking about. It just didn't make sense. It couldn't go much further from where it currently was. Like you saw this candle right here, super overextended from the 5 EMA. Typically you get it pull back when that takes place. So then we started moving down, consolidating. This day obviously was a pretty scary looking day. A lot of fear out in the markets. Overall, the bears did take a lot of control back. They are below the 50-period moving average, so that's good for the bears, bad for the bulls. They're below the 20, they're below the 5 EMA. Just the other trading day, we were talking about this candle right here, how things look bullish. I personally thought that we're going to see continuation to the upside, but my only hesitation was that this hanging man candle at this area of resistance could represent potentially pullback. And this channel right here did hold up. So we got pulled back into it. We went a little bit lower, filled that gap, bounced up, and now we're within this bull flag. So why am I not really scared right here? Well, first off, we need to see more continuation. Yes, we still have a couple gaps below us. And once we get into the indicator, you'll see like, okay, so where can this potentially fall to? Well, first off, my strategy during all of this has been to be risk off. So I'm only doing long positions at major areas of support. And I posted on Twitter today. If you don't follow me on Twitter, follow me there. If you don't follow me on Instagram, follow me there. Like I said, I'm still working out some content stuff for those channels to be able to get everything out easier. I posted when it got lower to the bottom of the channel, it looked really, really scary. But all the indicators were telling me it was just an overextended move, and then we saw a little bit of a bump up, and this long upper wick kind of represents that move. So right now, I'm personally, this doesn't scare me from the bulls perspective quite yet. I would say that if it starts closing through this, then that's when it gets a little bit more, iffy. As far as long positions go, once we get into the other time frames, I'm just looking at major areas once again. So I'm in a long position right now that I got into the lower portion of this channel, and I'm up just a little bit. If we start closing out, I'll have a hard stop underneath the trend line, and then these two other gaps should act as a level of support. So I'll be looking at those areas for potential buying in opportunities on those pullbacks. I'm not particularly shorting this market. The way that I'm shorting this market is being risk off for the majority of just this current time frame. By being risk off, I'm talking cash, I'm in gold, I'm in silver, and I'm also in some treasury bonds just to be a more low risk during this times of heavy volatility. Here is the VIX, and we'll get into another VIX. This is the inverted VIX, and what I kind of want to show here, and I like this because it's really easy to read, but when you invert it, it moves with, obviously, the S&P 500 for the most part. So I have the Bollinger Bands extended, are overlaid on this. So what I want to really just kind of point out is when things get overextended on the Bollinger Band, when the VIX gets overextended, you can typically see pull contraction. So it gets overextended and then you see it contract back. So right here, for example, it created a nice hammer candle, overextended. And if you look down, right throughout this area is when it was pulling in, and then we saw a little bit of ramp up on the S&P 500. You can just, go through this chart and kind of just look at the different levels. Right here, boom, right here, boom, ramped up. Right here, you had a lot of overextended moves all the way down to this range, and we saw a little bit of a run up. Now what we're seeing right here is we're getting overextended as well. Now this is on the 2-hour time frame, and the reason why I'm showing you this is because what it's nice to match up with is areas where it gets overextended on the RSI as well. And as you can see here, the RSI is in that overextended territory. You match that also up with the Bollinger Bands. Then you look at the S&P 500 and it has a nice hammer candle on this 2-hour time frame, and then a follow through. So this could represent just a little bit of a bounce point. This was at that bottom portion of the channel. So everything looked pretty good for the most part. On the 30-minute time frame, this is the one that I was talking more about intraday. We started getting oversold in the RSI, and then we saw that move up. Came to the bottom of the channel. That's when we notified it, and boom, we saw that bounce up into the close. Now, this could be called a bear flag, right? So big pull, then you're seeing this little bump. What you want to be careful for here is once you start seeing some sort of signs of weakness, that could potentially resemble it coming to a close, like a dead cat bounce. So it come down, boom, bounce, and then you might see it start heading lower. So we got to be careful for that to happen. Now, this market has been driven by just news headlines as of recently. So stimulus news, vaccine news, COVID news, whatever the case may be, it has been highly just volatile to a bunch of different news headlines. And we got to make sure that we're positioning ourselves to be careful with that. And the way that I'm doing it, like I already previously stated, was I'm staying away from shorting this market, even though when you look at this kind of stuff, like, wow, but if you shorted it, it would have been a great day. That's not how you should look at it. Let me tell you why. First off, this head was poking out. That's what we talked about in the previous video, and it actually looked like it was about to break out. So that would not actually be a good time to short regardless, because it was showing signs of strength. So if we did continuation to the upside, then that short position could have got blasted. Now, why wouldn't I go short this current market? It's quite simple. One, like I already mentioned, we're being really driven by the news headlines. But two, even on a big down move, if my positioning is risk off, if I'm focused on risk off, so I have cash positions, treasury positions, I have gold, silver, so I'm not in the equities market. I'm not in these high beta equity swings. On these down moves, the majority of the market gets hit to the downside, but my capital is protected. That to me is a winning trade. And I've heard other people say like, I'm just going to sit this out. That's awesome. That sitting out is a position. Cash, it's a position, and it's a good position to be in if times are like this. And what we're seeing right now, this right here, whoever was in a cash position won today. It's as simple as that. Cash positions won. Anybody in the equities market really did get hammered to the downside today if they weren't, looking at key levels. Here's the NASDAQ 100, still in this cup and handle formation or bull flag, whatever you want to call it. Came down, almost filled this gap in today. And, just a lot of back and forth. So we came to the top of it and we came to the bottom of it today. We finished just a little bit lower. Now, this is below the 5 EMA and it's below the neckline of this previous inverse head and shoulder kind of breakout, and then we reform the pattern. So overall, bears do have momentum here, and it could very well continue lower into this, but we will see. Let's talk about the other indexes. First, I want to talk about the semiconductor index. The semiconductors make up a big portion of the NASDAQ. So when semis aren't doing well, it's likely to see the NASDAQ not doing too well. And we called this out, these divergences, a few weeks back, or a couple weeks ago, or a week ago. I don't really know when, but we did. It was just on just this monster tear. But then we saw this negative divergence. We called this before actually it started down ticking. And look at what's going on. I mean, we saw previous history, and we didn't even need to look back far. In early 2020, negative divergence. Right here in May of 2019, negative divergence. Boom, to the downside. Positive divergence over here in November to December in 2018. And then boom, we saw it move to the upside. So what do we got going on? Well, what we got going on is a negative divergence that we're seeing follow through. Now, this is what's interesting, okay? Semiconductors are weak right now, short term, but the overall trend is still bullish. So what does that mean? Well, if the semis are in a bullish trend, but they're seeing short-term weakness, that tells me as a trader and investor is to look for areas of support that you can buy into to potentially see the continuation to the upside. All right, so I'm not shorting this strength. I'm looking for key levels of support to buy into, and then I have stops underneath that. Where's the support here? Well, the 50-day period moving average should act as a support. It has previously right over here in September through October. So 2,261, that right there for the SOX index. So what I would do is if the price keeps coming into this level, I'll be looking at individual semiconductors, for example, NVIDIA, AMD. There's a bunch of other ones that you can look into, big companies, that might be pulling also back to a key level of support and or forming a pattern that might be potentially looking to break out. And then you could play those trades. So be patient here. This is why I'm not too worried about the current pullback because of the context. There's so much fear right now. It was crazy to see how much fear there was. Why, I was kind of sitting back and just watching it roll out. Here is the transportation index, another big key component to this big picture here. All right, and what did we call out? Well, we called out the negative divergence that was taking place a while ago. And it was getting frothy. It was getting back to overextended here in the 70 range, but it didn't make a new high. Although when you looked here, it was making a new high in the price action, and then we're seeing it pull back. Okay, if you look at the airlines today, they didn't do too good, did they? And then right here, negative divergence, boom, to the downside. Now, with this negative divergence, it's not even moving down that much, to be quite honest, and the RSI is actually holding this little trend right here. So this, to me, if it starts breaking down, yeah, we can head lower, right? So we got to watch out for the break of this lower 50 level. And, the overall context of this chart, it's not as bullish as the semis, but it's still bullish. The 50 period is sloping up nicely. The 200 is kind of curving to try to slowly, it's just like a big cruise ship, trying to just turn back up. That doesn't mean that this thing can't rip down to the downside. So don't think that that's not the case. But what am I talking about here? Well, I'm saying when we pull back to a level of support, say this 50-day period moving average, it's 11,338, you might be able to look at transportation plays while this pulls back into this area, because you'd be looking for a key level of support, and then you would look into individual stocks or sectors or whatever the case is to make it play around that. So is there more downside potential in these indexes? Can it bring the market a little bit lower? Yes, but what I am seeing is there's still support underneath us that can hold this market together until further notice. Now, there's a lot of stuff that can unravel this market. Presidential election. That's one. Second wave or third wave or whatever. I think Dr. Fauci said that we haven't even gotten through the first wave yet. So there's that kind of overhanging too with all of this. So we got to be careful And that's why when we pull back to areas of support, we can have stop losses. Let's talk about a few indicators. First indicator that I want to talk about is the CPC, smooth over 10 period moving average. This is our sell signal indicator. We crossed over today. What do you know? Not surprised. Crossed over 8, that's the sell signal warning. Now, when we get crossed over, cross from down back to above, typically you can see some more pullbacks take place. And we've seen that time and time again. When it crosses down through under it, that's that warning sign. The warning sign says, okay, be careful here because things could start getting choppy. When we crossed down here, guess what? Things started getting choppy. Now we crossed back over today and we're seeing more downwards momentum. So this could be an early sign. Now, this doesn't mean that the market can't bounce from here. It has in the past, but this is a signal to say, hey, let's proceed with caution going forward. And when we talk about the NIMO, which we'll do right now, this chart, what we've been talking about was this all-time high being built out on no, negative breadth. And then all of a sudden we saw the spike to the upside on a little bit of a positive breadth. That was a very fast increase from way down here to minus 80 to up here to 60, in a very quick move. Now, in order to know if this is a powerful move, it needs to kind of hold, not just sharply decline. And as you can see, boom, we saw that big move, but now we're seeing that sharp decline right here and back into negative breadth at minus 28. So, interesting. This, like we've been saying, looks a lot like 2018, where we had this high on negative breadth. We had a sharp increase and boom, came up and then ultimately spiked back down to negative breadth. And we saw a lower low from this pattern forming. So what we might be seeing here is the start of something very similar to exactly that. Here is the VIX on the daily time frame. This is our head and shoulders, inverse head and shoulders pattern. And we broke out of this trend line, saw some momentum to the upside. This is getting punchy. Pay attention to the RSI, getting a little frothy, can move a little bit higher. And then we have some resistance right overhead. So this neckline, if we start breaking above that, things could get very, very punchy. And we can see that, boom, break out to the upside into this original target where we're talking about I think, 40, 50 up in that range. So got to be very careful there. But yes, this pattern is still holding true so this is bearish in my opinion. I mean, this move, this breakout here, that's pretty bearish. But like I said, on the other VIX charts that we looked at, there's going to be swings. There's going to be movements back and forth, but we got to just look at key levels on the daily time frame. If we start breaking above it, we should definitely be prepared for obviously more volatility, bigger swings in the S&P 500. Let's talk about commodities for a few moments here. Commodities, we got gold. Gold was a good move today. That was a risk-off move. Didn't do much at all. So, just we broke out of this trend line and we just been going sideways. That's all we've been doing for a while now. Not really much to report. I've been saying the same thing. If we get above the 50-period moving average and hold above 1950 for a while, that's going to show us some strength in the gold, and we might get that continuation to the upside. That's what I want to see. Another part of me wants to see a complete breakdown so I can buy some more down here. Now the 200 period, it continues to slope up. That's a strong sign, and especially when it's coming into this area of support. So if we get a pullback to this range, keep an eye out here because that is going to be a great opportunity to pick up some more gold at a discount. Silver was more volatile today, down 1%, and this is that ascending triangle pattern that we've been watching, and it broke slightly out of it today. That's not that good of a sign for silver. That'll be a good sign for probably the dollar once we get to that chart, but starting to break down. Now, this isn't a full, complete breakdown yet, but if we start getting some momentum to the downside, you'll probably be seeing the dollar. We probably have to reshape it again. We have it as an inverse head and shoulders, a head and shoulders. I keep doing that. And we'd have to re-put it down to the cup and handles or just kind of that trading range we've been watching. So keep an eye out for the break above the 50 period and this ascending, this kind of horizontal line right here to get continuation to the upside. But as I see it right now, silver is looking pretty weak at this particular point in time, but things could change very quickly. Really quick, let's talk on yields now. We're looking at the 30, the 10, the 2, and the 3. And then these down here are some the curves. So we have the 10-year minus 2-year, which is a widely tracked one. And they've been steepening, right? We've been getting increases here. As you can see, the 10-year is rising and the 2-year is really just sticking stagnant and going straight. So these low interest rates here is encouraging, spending and stimulus. And while we're seeing now this kind of increase, these 10 and the 30-year, this is basically saying the people that are lending the money, the banks, they are commanding, higher prices. So it's going to cost more money, but yet people are getting that money right here, a lot less. So just a lot more stimulus is taking place. Overall, this can send, you can read this as, the broader economy is recovering. Now, it's just the other day, this curve reached above 0.7. We mentioned that, and that's been the highest we've seen for quite some time. This very well might be a real breakout, but it's very, very possible that this is just a temporary moment in time before we head lower. Today, overall, bond market did quite good. Yields did drop. We're at 0.81, which is still at a decent level. Let's see this get down lower and even potentially break through this trend line to really state that, okay, this was not a real breakout in yields. They're going lower. But as I see it right now, we're still trending in the upwards direction up until further notice. Let's talk about the dollar. The dollar is still an important chart. We have it as this head and shoulders pattern. I've been saying inverse head and shoulders, and people correct me. I'm like, yeah, I keep on doing that for some reason. It's a head and shoulders. You can look at it a couple ways, to be quite honest. But I drew this out because no one was really talking about the potential for this being the head and shoulders and this being the neckline, and we break through to the downside. So I wanted to put it out there. But I've been overlaying that with this, upper channel here and this lower channel right here, which is basically saying, okay, well, we've been stuck between 95 and 92. So this has been in just a channel that's going sideways. This could very well be basing higher. The longer the base, the higher in space, right? Or this could very well be just a cup and handle, which we drew out previously. Now, if it continues to break down, I'd say if it gets under 92.5, I wouldn't consider that a cup and handle anymore at that point. I would just be looking at this this head and shoulders and this channel that it's currently trading within. If the dollar breaks down through that neckline, gets below 92, that will be very good for gold and silver. If it starts cracking to the upside, that could apply a lot of pressure on the equities market. That'll be a big risk-off type of move. So equities can go down if the dollar really spikes higher. So you got to be very careful and positioned well in order, to withstand that type of move if it is a cup and handle or basing pattern that wants to move out. So that's all I got for you on today's stock market brief. Wild day in the markets overall. My thesis, my kind of narrative here continues to remain the same. It's buying the dips at major areas of support and ensuring that I have a stop loss. I'm not shorting the markets, and I'm also not fully exposed to the market. So when we see days like we saw today, really big rips to the downside, my capital is completely protected. And that's how you can win over the course of a long time investing, trading, whatever the case is. If you're protecting your capital, you will win over time. So that's all I got for you on today's stock market brief. I will see you all on the next one.